Imagine acing every single exam, breaking all the school records, and still getting expelled.
Right, which makes absolutely no sense.
It makes zero
Yeah.
sense. But that is exactly the bizarre scenario playing out on Wall Street today with, well, one of the most recognizable brands on the planet.
Yeah, it really is.
Welcome to today's deep dive. We've got our hands on the Netflix Q1 2026 earnings report, along with the official call transcript from April 16th, 2026. And, just looking at the raw numbers, there is this glaring contradiction.
Oh, a massive contradiction. I mean, Netflix absolutely crushed expectations here.
Right. They reported an EPS of $1.23.
Yeah.
The market was expecting, what, 76 cents?
Yeah, 76 cents. It just left that in the dust.
Exactly. And revenue hit $12.25 billion, which is up 16.20% year over year. They even maintained their full-year guidance for that 12% to 13% revenue growth.
And they locked in an operating margin target of 31.5%. So by every traditional financial metric, they delivered a total masterclass in corporate performance.
Which is great. But the paradox becomes apparent the second you look at the market's reaction. Because despite that flawless financial report card, the stock crashed roughly 10%.
Yeah, plummeted right down to $97.23.
Exactly. And the financial press is just dominated by these headlines screaming about a, quote, disappointing outlook, completely overshadowing the actual quarterly performance.
Which is wild, and it makes absolutely no sense until you dig into the fine print.
Right, and that's our mission today. We're going to unpack this massive earnings document and decode exactly what is happening inside the world's biggest streaming company. We're moving past the panicked headlines to look at the machinery underneath.
Because there is a lot going on under the hood. Surprising new acquisitions, the refusal to buy a major Hollywood studio, and honestly, an incredibly aggressive expansion into areas you would never really expect.
Yeah, so for you listening, whether you're an investor trying to cut through the market noise or, just someone who spent the entire weekend binge watching the new season of Beef,
Yeah.
this deep dive is going to reveal the very real, very expensive battle for your screen time.
Yeah, it's a battle.
So let's start with the big one. The elephant in the room, the M&A deal that everyone expected, but that never actually materialized.
You're talking about the Warner Bros. Situation.
Exactly. Wall Street had basically priced in this expectation that Netflix would acquire that legacy studio. But management used this call to officially confirm they walked away.
Yeah, co-CEO Ted Sarandos said point blank that the WB deal was a nice to have, not a need to have.
Ouch.
Right. And they pulled the plug the moment the cost of the deal outpaced the net value to the business and the shareholders.
Okay, let's unpack this.
Yeah.
Because it's kind of like walking away from a shiny, overpriced sports car because the dealer fees were ridiculous, right? It proves you have ultimate financial discipline.
That's a great way to put it.
But if they didn't buy a legacy studio, why are they buying a company called Interpositive? Because they passed on the WB catalog, but their $275 million M&A budget didn't just vanish.
No,
It pulled some WB costs forward from 2027 into 2026, but they funneled a significant portion of that budget into this totally different acquisition, this Interpositive. To me, that signals they aren't interested in owning the past of Hollywood. They're trying to own the infrastructure of its future.
What's fascinating here is the specific mechanical advantage Interpositive provides. It's a proprietary generative AI technology, but it's built from the ground up specifically for the filmmaking process.
Wait, so we aren't talking about like a generic consumer video generator where you just type in a prompt?
No, not at all.
Ah.
By purchasing Interpositive, Netflix is choosing to deeply integrate AI into the actual production pipeline. Sarandos detailed how their talent is already using these tools for heavy lifting tasks.
Like their kind of tasks?
Things like set references, pre-visualization, complex visual effects mapping, sequence prep, and shot planning.
Wow. So instead of buying the finished art, they are basically buying an incredibly advanced paintbrush.
Exactly. And a paintbrush that solves massive logistical headaches. Like one of the most overlooked aspects Sarandos pointed out was on-set safety.
Oh, really? How does AI help with safety?
Well, in traditional filmmaking, planning hazardous action sequences requires physical walkthroughs. And those carry inherent risk and cost immense amounts of time and insurance money.
Oh, that makes sense.
Right. But with Interpositive's pre-visualization AI, directors can map out dangerous rigging and camera angles in a hyper-realistic virtual environment before a single stunt person even steps on set.
So it's basically a massive force multiplier.
Exactly. And Greg Peters, the other co-CEO, emphasized that owning this proprietary tech accelerates their internal capabilities. It stretches the efficiency of the massive content investments they are already committed to making.
I can hear the collective anxiety of the creative industry from here, though. I mean, whenever a studio buys an AI company, the immediate fear is that the algorithm is going to replace the human element of filmmaking.
Yeah, and Netflix met that anxiety head-on during the call. Sarandos offered a very deliberate quote to calm the waters. He said, "It takes a great artist to make great art, and AI won't change that."
AI won't change that.
Okay. The corporate stance is that Interpositive is strictly a tool to remove friction from the production process, allowing artists to execute their vision more safely and cost-effectively, not to replace the visionary themselves.
Well, they are making a massive bet on production efficiency. But, efficiency only matters if you actually have an audience watching the final product.
That is very true.
To justify walking away from iconic IP like Warner Bros.
Yeah.
To fund back-end AI, Netflix needs bulletproof evidence that their audience is highly engaged. And that requirement is creating a massive friction point regarding how we actually measure viewership.
Yeah, the scale we were talking about here is staggering. Netflix ended last year with over 325 million paid members.
Which is huge. And since those accounts are shared within households, they are entertaining an audience approaching 1 billion people.
A billion people. Yet, even with that massive footprint, management highlighted they still have less than 45% penetration in addressable households.
Meaning homes with smart TVs and reliable broadband.
Exactly. And perhaps most surprisingly, they estimate they only capture about 5% of global TV view share.
That 5% metric is just wild to think about given how ubiquitous they feel.
Right?
But how they define and measure that 5% is causing a lot of drama, particularly with traditional measurement firms like Nielsen.
Oh, the Nielsen spat.
Yeah, Netflix is actively abandoning the old metric of raw view hours. Instead, they are leaning entirely on this highly guarded primary member quality metric.
And they proudly announced that in Q1, this secret metric hit an all-time high.
But when analysts pressed them on the math, Greg Peters completely stonewalled them. He refused to share the formula, claiming he didn't want to hand competitors a cheat sheet.
And the timing of that refusal is really what spooked the market, because Nielsen recently changed the methodology of their widely cited Gauge report. How did they change it? So Nielsen tweaked their algorithm to weigh passive background viewing differently. This subtle change disproportionately hurts streaming platforms.
Oh, because streaming apps are often designed to automatically time out and ask, are you still watching?
Exactly. While it heavily rewards traditional broadcast and cable boxes that just get left running all day in empty living rooms or waiting areas.
I see. And Netflix completely brushed off this Nielsen methodology change. They basically said it's an artificial data tweak that doesn't reflect actual human behavior.
They did. They are so confident in their own internal numbers that they reaffirmed their massive target of hitting $3 billion in advertising revenue this year.
$3 billion. Supported by an advertiser base that grew over 70% year over year to more than 4,000 brands. And programmatic ads are now passing 50% of non-live ads.
Yeah.
So what does this all mean? When a massive company says, trust us, our secret internal metric is great, but we won't tell you how it works. And by the way, that third-party Nielsen data is flawed. Isn't that a massive red flag for investors?
I mean, it feels exactly like grading your own homework and refusing to show the teacher your math.
Right.
It is entirely valid for investors to view that stance with deep skepticism. And honestly, it's a huge driver behind why the stock dipped despite the earnings beat.
Okay, so why should anyone trust them?
This raises an important question. How do we accurately value modern media when the legacy rating systems are misaligned with digital product design? If we look at the underlying mechanics of Netflix's business model, we can deduce why they trust their secret metric.
Okay, I'm listening.
They tie this primary member quality metric directly to the harshest reality check in a subscription business. Retention and churn.
Oh.
Yeah.
So if the metric is a lie, people will vote with their wallets and cancel.
Precisely. That's the point CFO Spence Newman made. He noted that churn improved year over year in every single global region.
Wait, really? Every region?
Every region. That is a staggering achievement, especially because it happened concurrently with recent subscription price hikes in the U.S. market.
Okay, yeah, that makes sense. If their internal engagement metric was artificially inflated, a price hike would immediately trigger a wave of cancellations.
Exactly. The fact that retention held strong suggests the quality metric actually tracks real human satisfaction. And they back this up by pointing out that their $8.99 ad tier in the U.S. remains the most cost-effective SVOD option on the market on a per-hour viewing basis.
Okay, so the credit card renewals don't lie.
They never do.
But let's look back at that 5% global view share. Because if you have saturated the evening window for your existing subscribers and you refuse to buy a legacy catalog to coast on nostalgia like the WB deal, you have to fundamentally change the type of attention you are hunting for.
You do. You have to find totally new hours in the consumer's day.
Right, and you have to step outside the traditional boundaries of television and film, which leads directly to their aggressive moves into live events and audio.
Yes. The proof of concept for this expansion was the World Baseball Classic in Japan.
Oh man, Ted Sarandos was practically glowing when talking about this on the call.
I loved it.
It was an absolute monster of an event. It pulled in 31.4 million viewers, instantly becoming their most watched program ever in Japan.
And it drove the largest single sign-up day in the country's history.
Yeah, it resulted in the highest quarter of paid net ads there, ever. And it even generated a massive halo effect. Viewership for their scripted Japanese originals, like One Piece, surged back into the top 10 because all those new sports fans were exploring the app.
That single event was a primary reason the APAC region became their strongest revenue growth market for the entire quarter.
It's incredible.
Because live sports offer a uniquely powerful acquisition mechanic. Think about it. Scripted television relies on asynchronous viewing. You can watch it whenever you want.
Right, on your own schedule.
But live sports demand immediate concurrent attention, which drives massive spikes in simultaneous sign-up.
But they aren't just buying up every game broadcast they can find, right? They are avoiding standard season-long NFL packages.
Yeah, they favor what they call breakthrough events.
Right. They secured the upcoming Christmas Day NFL games, opening MLB games, and a new multi-year CONCACAF deal in Mexico. They want the cultural flashpoints.
Exactly.
And simultaneously, they're launching a massive assault on the audio space. They announced a heavy-hitting podcast slate. We're talking the Bill Simmons podcast, The Breakfast Club, Therapist from Jake Shane, and new exclusive shows from Brian Williams and Pete Davidson.
It's a huge push.
Here's where it gets really interesting. They aren't just trying to be your Friday night movie date anymore. They want to be in the passenger seat during your morning commute and sitting at the bar with you for the big game.
Yeah, if we connect this to the bigger picture, this is a masterclass in the economics of incremental engagement. Consider the profit margins and the acquisition value.
Okay.
A highly produced narrative show like Beef, which, by the way, they just announced is getting a season 2 starring Oscar Isaac and Charles Melton, costs millions of dollars per hour to produce.
Millions.
And it demands 100% of the viewer's visual and auditory attention, usually in the evening. Audio podcasts, on the other hand, have incredibly low production overhead, massive margins, and index heavily during daytime hours and mobile phone usage.
Yeah, it is the ultimate multitasking medium. You can't safely watch a premium drama while driving to work or, doing the dishes.
No, you really shouldn't. So by adding podcasts and live regional sports, Netflix is actively diversifying the type of attention they capture. They are optimizing for the gaps in your day.
Right.
Professional TV and film historically represent a tiny fraction of mobile viewing. Audio breaks that barrier, allowing them to monetize the hours of the day when a screen isn't readily available.
Right. Say they have your morning commute locked down with Pete Davidson, your weekend afternoons with live baseball, and your evenings with premium AI-assisted scripted dramas.
Yeah.
But to truly dominate a household budget, you have to win over the demographic that often dictates family spending.
The kids.
The kids.
Yeah.
And that requires a completely different psychological approach.
It really does. The youth demographic and the gaming sector are massive. Gaming alone is a $150 billion global market, and that's entirely separate from the advertising revenue potential.
Wow.
And Netflix is now in the 5th year of its slow-burn gaming strategy. Greg Peters noted that their data clearly shows gameplay positively impacts member retention, even if it isn't driving massive waves of new signups just yet.
Well, the major announcement on this front is a brand new app called Netflix Playground.
Yeah, this is huge.
It is a standalone environment built exclusively for children, featuring curated, highly protective IP, things like Peppa Pig, Dr. Seuss, and Bad Dinosaurs.
Very safe content.
Very safe. But the kicker here is the monetization model, or rather, the lack of one. There are absolutely zero ads and zero in-app purchases. It functions entirely as a pure value add to the existing core subscription. Right. So wait, if they're explicitly trying to double their advertising revenue to $3 billion this year, why build an entirely separate app for a highly engaged demographic that explicitly locks out advertisers and microtransactions? Aren't they leaving a mountain of money on the table?
Well, in the short term, looking at an isolated spreadsheet, it absolutely seems like a missed revenue opportunity.
Right.
But strategically, it is a brilliant long game built on the psychology of parental trust. The iPad babysitter dynamic is a real factor in modern parenting.
Oh, for sure.
By providing a walled garden, a completely safe gaming and viewing ecosystem tailored for tablets and mobile devices, Netflix is solving a massive pain point for parents. Parents are exhausted by predatory microtransactions and inappropriate ads on other platforms.
Oh, so it basically transforms this subscription from a luxury entertainment expense into a mandatory household utility.
Exactly. The mechanism here is churn defense. If a family's children rely on Netflix Playground for their daily entertainment, and the parents implicitly trust the platform because it refuses to nickel and dime them, the likelihood of that household canceling their $15.49 monthly subscription drops to near zero.
That makes total sense.
They are willingly sacrificing short-term ad revenue on the Kids app to heavily fortify the recurring revenue of the core subscription. And that core subscription is what funds their entire multi-billion-dollar content engine.
It is a phenomenal retention strategy.
It really is.
But, as they execute this wildly ambitious pivot, moving from DVDs to streaming to AI production, live sports, podcasts, and now ad-free kids gaming, the very foundation of the company's leadership is undergoing a seismic shift.
Yes.
The primary architect of this entire empire is stepping out of the room.
We're talking about Reed Hastings, the co-founder, former CEO, and current board chair. He announced he is not standing for re-election to the board at the upcoming annual meeting.
Yeah, and just to head off the financial gossip, Ted Sarandos explicitly clarified on the call that this departure has absolutely nothing to do with the Warner Bros. Deal falling through.
Right, there is no palace intrigue here.
None. The board was completely unanimous on walking away from WB.
Which is important to note because corporate successions of visionary founders are notoriously messy. I mean, you only have to look at other major media conglomerates to see how often legacy CEOs return to save the company.
Yeah, that happens all the time.
Hastings actually executing a clean exit is a statistical anomaly.
And the tone on the call was incredibly genuine. Both Sarandos and Peters delivered these very emotional tributes to Hastings. They highlighted how meticulously this was planned. I guess Hastings initiated a 10-year succession blueprint and is actually stepping away comfortably after just 6 years of execution.
Yeah, 6 years.
CFO Spence Newman even chimed in. He referred to Hastings as an N of 1, which is a clever nod to the iconic red Netflix N logo. They praised his culture of transparency and his relentless push to drag the entire entertainment industry into the digital age.
Because building a revolutionary product is one thing, right? Building a self-sustaining corporate culture is entirely different.
True.
Sarandos pointed out that Hastings built a culture of risk-takers where character matters. He engineered an environment that demands passionate debate to find the absolute best answer, but strictly enforces unified support for the final decision once it's made, regardless of personal disagreements.
Wow. And that level of disciplined aggression is what allowed them to pivot so many times without tearing the company apart from the inside.
Exactly. And the real stress test for Netflix won't be seen in the Q2 earnings report, or even whether the interpositive AI integration works seamlessly.
Well,
The existential test is whether that unique risk-taking DNA survives in the boardroom without its N of 1 founder sitting at the head of the table to enforce it.
yeah, that is the multi-billion-dollar question. And when we pull back and look at the entirety of this earnings report, the initial paradox vanishes. The stock may have dropped on a misunderstanding of a Nielsen metric tweak, but under the hood, this is a company executing a surgical, highly disciplined evolution.
Absolutely.
They refused to overpay for Warner Bros. And instead bought an AI company to redefine how movies are physically made. They are aggressively protecting their core subscription with an ad-free kids gaming ecosystem while simultaneously hunting for your morning and weekend attention through massive podcast deals and live sporting events.
They are completely redefining the boundaries of their total addressable market while maintaining strict financial discipline during a major leadership transition. It's impressive.
So for you listening, it is really worth keeping in mind that every single time you open the app, whether you are tuning into a live baseball game, firing up a comedy podcast on your drive to work, or handing the tablet to your kids so they can play with Peppa Pig, you are an active data point in the most expensive, complex experiment in human attention ever conducted.
That's entirely accurate. And I will leave you with a final thought to mull over. If Netflix successfully captures your morning commute with their audio network, they capture your kids' afternoon with the safe walls of the Playground app, and they capture your evening with live sports and AI assisted blockbuster movies, are they still just a streaming service? Or are we watching the birth of the world's first completely enclosed lifestyle and entertainment ecosystem? Think about that the next time you hear that dumb sound.